In today's video, I want to explain what the real estate syndications are, how fractional investing works, and why these strategies can really be a terrific way to get started in real estate investing. So just sit back, relax, grab a pen and paper, and get ready to learn about the exciting world of real estate syndications and fractional investing. So let's start by clarifying that syndications and fractional investing are really two different strategies, even though both ways allow investors to participate in real estate investments without having to buy an entire property all on their own. In the video, I want to outline each strategy and include 5 key questions that you should ask before you invest in either one. Let's start with real estate syndications. A real estate syndication is a business structure in which a group of investors pool their money together to purchase and manage a real estate investment. The investors are called syndicate members. They may be passive investors who provide capital but really don't take on any active role inside managing the property, or they may be active investors who are involved in the day-to-day management of the property. The syndicate is typically managed by a real estate sponsor who is responsible for finding, negotiating, and managing the investment on behalf of the syndicate. Now, as a passive investor in a real estate syndication, you're going to contribute a portion of the capital that's needed to purchase the property. And in return, you'll receive ownership shares in that property. And that means that you'll receive regular passive income payments and a return on your investment when the property is sold, as well as equity pay down, appreciation, and real estate tax benefits. Now, a simple Google search will give you a list of some of the top real estate syndications that you could invest with, but it is important to carefully research and evaluate any investment opportunity, including real estate syndications, before you make any decisions. Hopefully that goes without saying, but we say it anyway. Now, here are some things that you might want to consider when you're evaluating real estate syndications. The first is the sponsor. It's crucial to know the sponsor's track record, whether or not they have experience in the type of property that's being syndicated. The second that you want to think about is the investment itself. See how the investment opportunity fits with your investment goals and your personal risk tolerance. Be sure to find out what the risks and the potential returns are for the specific investment that you're considering. The third is that you want to look into the terms. You want to find out what the terms of the syndication are, including the minimum investment amount that's necessary, the length of the investment, and the distribution of profits. Number 4 on this list is the property itself. You'll want to know the condition of the property, how it'll be managed. Be sure to dig deep into this and find out if there are any environmental or other issues that could impact the value of the property down the road. And 5 on this list is the legal structure itself. Look into the legal structure of the syndication and find out how it protects the interests of the investors. With any big investment, it would be wise to consult with a financial advisor or an attorney in this process before you make any investment decisions along the way. And they can help you understand the terms of the investment and the potential risk versus rewards better. So there's the basics of real estate syndications. Now let's take a look at fractional investing. Fractional investing in real estate is a way for investors to purchase a small ownership stake in a real estate investment. Investors can buy into the investment through an online platform. They'll receive a share of the profits or income generated by that property. And unlike a real estate syndication, fractional investing doesn't usually involve a sponsor or require investors to be actively involved in the management of the property. There are many fractional investing platforms out there, and some of the most popular include Fundrise, Arrived Homes, Happy Nest, Honeybricks, and Lofty.ai. Now, here are some things that you want to consider when evaluating fractional investing into real estate. Number 1, the platform itself. What is the reputation and the track record of that platform? Make sure you're checking into the reviews. Dig into third-party resources to find out the good, the bad, and the ugly. Even checking here on YouTube is a good start. Also, be sure to find out how the platform screens the investment opportunities that it offers, which takes us to number 2 here. What is the investment opportunity itself? How does it fit with your investment goals and, of course, your risk tolerance? Again, what are potential returns and, of course, the risks associated with those returns? Be sure to do your due diligence, of course, on the investment itself. Don't just trust that the platform will only provide excellent investment opportunities. Look through the ones that they offer and then find the best option for your personal risk tolerance and your investment goals. Number 3 here on this list are the terms again. Find out the terms of the investment, including the minimum investment amount, the length of the investment, and the distribution of the profits. The 4th on this list is the property itself. What condition of the property is it? How is it being managed again? Are there any environmental or other other issues that could impact the value of the property. Not too different than before. Just be sure you get these questions answered so that you know the property isn't a lemon, basically. And the final number 5 on this list is the legal structure once again. You're going to want to know the legal structure of the investment, how it protects the interest of the investors. Of course, again, bringing in any type of guidance, legal guidance, counsel is very important. Okay, so do your due diligence before investing with any fractional investment firm, and that may include consulting with a financial coach of some sort. Excluding us, I would not be the right person for that role, but I would say an attorney, absolutely you should be bringing in, or a financial advisor. They can help you understand the terms of the investment and, of course, the potential risk and reward. Now, before we end the video today, I'd like to leave you with a couple of key differences between real estate syndications and fractional investing. One key difference between real estate syndications and fractional investing is the level of control and involvement that investors have in the investment itself. In a syndication, investors may have more control and they might be more actively involved in the management of the property, while in fractional investing, investors typically have less control and are more passive. Another difference is the minimum investment amount. Real estate syndications may have a higher minimum investment amount compared to fractional investments, which can make it more accessible to a wider range of investors. So that's really it, the basics, or at least a guide of the basics on these two real estate investment strategies. Curious about what you think when it comes to real estate syndications and fractional investing. Have you ever invested in either of these yourself? If so, what was your experience like? Be sure that you leave comments below so that all of us can chime in and learn from what you took away from that experience. If you'd like us to do deeper dives into these strategies, make sure you drop a thumbs up on this video. I'm actually looking at bringing in some syndication or fractional investing opportunities for you guys here on the channel, so we're always out exploring those types of things. If you're interested in that, make sure you let us know in the comments below as well. And if you haven't yet become a subscriber, consider subscribing. We would love to have you as part of the Cash Flower community. Of course, until we see you on the next video, we're grateful that you joined us here again today. Make it a great day today, but most importantly, my friend, keep on cash flowing. We'll see you soon.